Most people invest in either all active funds or all passive funds and lose money because they don't understand one crucial secret. Today, I'm going to show you my exact 6 fund portfolio that combines both strategies to maximize returns while minimizing risk. I will break down my complete portfolio of 3 passive funds and 3 active funds, explain exactly what makes a fund active versus passive, show you the real performance numbers with proof, and reveal why having both types is the smartest strategy for long-term wealth building. In active funds, there is a fund manager who makes decisions every day. This person studies companies, analyzes market trends, and actively buys and sells stocks trying to beat the market. The fund manager has full control over which stocks to pick, when to buy them. For example, if the fund manager thinks technology stocks will do well, they might put 30% of the fund in tech companies. If they believe banking stocks are overvalued, they might reduce the banking allocation to just 10%. They are constantly making these judgment calls. The goal is simple: beat the benchmark index. If the Nifty 50 gives 12% returns, an active fund manager wants to give you 15 or 18% returns. But here's the catch: they might also give you 8% returns if their decisions go wrong. Active funds typically charge higher fees, usually between 0.5% to 2.5% per year, because you are paying for the fund manager's expertise, research team, and all the trading costs. In passive funds, also called index funds, there is no fund manager making daily decisions. The fund simply copies a market index like Nifty 50, Nifty Next 50, or Nifty 500. If HDFC Bank makes up 10% of the Nifty 50 index, then the passive fund, that is Nifty 50 index fund, will have exactly 10% in HDFC Bank. The fund automatically adjusts whenever the index changes. If a company gets removed from the index, the fund sells it. If a new company gets added, the fund buys it. Everything happens mechanically without human judgment. The goal is not to beat the market but to match it exactly. If Nifty 50 gives 12% returns, a good passive funds gives you around 11.8% to 11.9% returns after accounting for the small expenses ratio. Passive funds charge much lower fees, typically between 0.05% to 0.5% per year, because there is no expensive fund manager or research team to pay. So now let me show you 3 passive funds with real numbers and why I choose one. First is Navi Nifty 50 Index Fund Direct Growth. The fund tracks the top 50 companies in India. The current NAV is 16.22 and it has given 12.76% annual returns since inception. The expense ratio is just 0.06%, which is incredibly low. This means out of every 100 rupees I invest, only 6 paisa goes to fees annually. The second is ICICI Prudential Nifty Next 50 Index Fund Direct Growth. This tracks the next 50 largest companies after the Nifty 50. The NAV is rupees 62.09 with 12.59% annual returns. It gives me exposure to mid-cap companies that have huge growth potentials. Companies like Interglobe Aviation, Hindustan Aeronautics, and Divi's Laboratories are in this fund. These are companies that could become the next HDFC Bank or Reliance in 10 to 15 years. Third is Motilal Oswal Nifty 500 Index Fund Direct Growth. This is my broadest passive fund, covering 500 companies across large, mid, and small caps. The expense ratio is just 0.17%. It has given 17.92% over the 3 years. This fund gives me exposure to the entire Indian market. While Nifty 50 covers the large caps, the Nifty Next 50 covers emerging large caps. These funds add small cap and mid cap exposure too. The fund has 2,467 crores in assets under management. Together, these 3 passive funds give me complete market coverage at a very low cost. They form the stable foundation of my portfolio. Now, let me show you 3 active funds that aim to beat the market. First is Parag Parekh Flexi Cap Fund Direct Growth. This is my favorite active fund with a NAV of 92.06 and a 20% annual return since inception. The expense ratio is 0.63%, which is reasonable for active management. What makes this fund special is that the fund manager can invest in both Indian and international stocks. This gives me global diversification within one fund. Second is SBI Small Cap Fund Direct Growth. Small cap companies can give explosive returns but are very risky. That's why I want an expert fund manager handling this space rather than trying to pick some small cap stocks myself. The fund has an NAV of 192.15 with 24.43% annual return since inception. The expense ratio is 0.7%. The fund has 34,000 crores in assets. Small cap funds are volatile. This fund's best annual return was 125.65%, but worst was minus 25.24%. However, over long periods, small caps have historically outperformed large cap funds significantly. Third is Motilal Oswal Mid Cap Fund Direct Growth. Mid cap companies are the sweet spot. They are more stable than small caps but have higher growth potential than the large cap. They are somewhat volatile, not as volatile as the small cap. The fund has strong performance with the regular plan giving 59.67% returns in the last year and 37.4% returns over the 3 years. The direct plan expense ratio is 0.63%. The fund has 26,000 crores in assets. Mid-cap funds require active management because this space has lots of opportunities and risk. A good fund manager can identify mid-cap companies before they become large cap and deliver superior returns. So now the question is, why having both active and passive funds? Here's the secret most investors don't understand. Active and passive funds complement each other perfectly when combined intelligently. Cost efficiency. My passive funds charge an average of 0.3% expense ratio while active funds charge 0.65%. By having 50% in each, my overall portfolio expense ratio is around 0.47%. This is much lower than having only the active funds. Risk management. Passive funds ensure I never miss out on market returns. Even if all my active funds manager perform poorly, I still get market returns from passive funds. This acts as a safety net. Return optimization. Research shows that combining active and passive strategies can actually give better risk adjusted returns than using either approach alone. Passive funds provide the stable base while active funds add the alpha potential. Diversification. My passive funds give me broad market exposure while active funds let me access specific opportunities. The small cap active fund can invest in companies not even covered by the indices. Market cycle protection. Different strategies work different in different market conditions. In trending bull markets, passive funds do well. In sideways or volatile markets, good active manager can outperform. Let me show you how this combination has worked. Over the last 3 years, here's what the data shows. My passive funds gave me steady returns matching their indices. Navi Nifty 50 has given 15.39% annualized returns over the last 3 years. ICICI Nifty Next 50 has given 18.95% annualized returns over the last 3 years, whereas Motilal Nifty 500 has given 17.93% annualized returns over the last 3 years. My active funds delivered Parag Parekh Flexi Cup Fund 23.32% annualized returns over the last 3 years, SBI Small Cap 20.36% annualized returns over the last 3 years, Motilal Mid Cap 31.2% annualized returns over the last 3 years. The combined portfolio gave me better returns than pure passive while taking less risk than pure active. If you want to copy this strategy, here's exactly what you should do. Start with passive funds first. Put 60% of your investment in the 3 passive funds I mentioned. This gives you the stable foundation. Then add active funds gradually. Put 40% in the 3 active funds, but to do this slowly over 6 to 12 months using the SIP to average out your purchase price. Or you can start with the SIP for both passive as well as active funds. Rebalance annually. Check once a year if your allocation has shifted due to performance differences. If active funds have grown to 50% of your portfolio, sell some and buy more passive funds to maintain your target allocation. Stay consistent. Don't keep changing the funds every year. Give the strategy at least 5 to 7 years to show the results. The beauty of this approach is that it's suitable for everyone. Conservative investors can do 70% passive and 30% active. Aggressive investors can do 40% passive and 60% active. Adjust based on your risk appetite. Don't go all active thinking you will beat the market easily. Even the best fund managers have bad years. Having passive funds ensures you never fall too far behind. Don't go all passive thinking it's the safest option. You will miss out on wealth creation opportunities that good active managers can provide, especially in small and mid cap spaces. Don't chase last year's best performing fund. Both my active and passive fund selections are based on consistent long-term performance, not short-term gains. Don't ignore expense ratio. Even 1% difference in fees can cost you lakhs over 20 years due to compounding. Studies show that portfolios with 40% passive exposure delivered the same returns as all active portfolios but with significantly lower risk. The key insight is that passive funds allow you to be more selective with active funds. Instead of needing 10 active funds to diversify, you can just pick 3 to 4 excellent active funds and let passive funds handle the broad market exposure. Remember, investing is not about being right all the time. It's about being right enough times while avoiding big mistakes. This 3 active plus 3 passive strategy helps you do exactly that. Thanks for watching. If you found this helpful, don't forget to like, share and subscribe for more insights like this. Thank you.